Two investors. Same $50,000. Same goal. One finds a fund paying 11%. Real Wall Street names behind it. Monthly payments hitting his account like clockwork. He feels like he cracked the code because everyone else is stuck earning 4. The other one does the boring thing. A plain index fund. No special yield. No clever structure. The kind of investment people call lazy. 3 years later, the boring investor walks away with over $20,000 more. The man who chased 11% finished last. Today I'm going to show you exactly why. The real math. The hidden trap. And the one question that changes everything. Let's get into it. Welcome back to Money Made Simple, where we break down U.S. money topics in plain English. No jargon. No fluff. Just what actually matters. Hit subscribe if you're new. Let's go. Meet Jake and Marcus. Same age, same $50,000, same goal income they can count on every month. Jake does what feels smart. He finds a professionally managed fund paying 11%. Real Wall Street names on the brochure. Monthly distributions hitting his account like clockwork. He feels like he cracked the code. Everyone else is fighting over 4%, and Jake is sitting on 11. Marcus does the boring thing. A plain index fund. No special yield. No clever structure. At dinner parties, nobody asks Marcus about his investments. Because I bought the index again is not a conversation. But feelings and math are two completely different things. And the math on these two men is about to get very uncomfortable for Jake. Now, before I show you the numbers, I need to show you something hiding inside Jake's 11%. Something the brochure never mentions. Something most investors never find until it is too late. And once you see it, you cannot unsee it. Stay with me. Here's what Jake actually owns. Strip away the marketing, and it's a fund that lends money to private companies. Mid-sized businesses. The kind too big for a small business loan, but too messy to borrow the normal way on Wall Street. These companies need money. Jake's fund hands it to them, charges a high rate of interest, and passes that interest along to Jake as a fat monthly dividend. And on paper, it works beautifully. The companies pay double-digit interest because they have nowhere cheaper to go. The fund collects it. Jake gets his cut. Everybody's happy. For a while, it genuinely does work exactly like the brochure says. But here's the part nobody puts in the brochure. Picture one of those companies hitting a rough patch. Sales slow down. Costs climb. And the day arrives when it simply cannot make its cash payment. In any normal corner of finance, that moment has a name. It's called a default. A default is supposed to be loud. The borrower raises their hand and says, "I can't pay." Everyone can see the damage. It's ugly. But it's honest. Jake's fund does something different. When a borrower can't pay, instead of calling it a default, the fund simply says, "Don't worry about the cash right now. Just add what you owe onto the top of the loan. We'll settle up later." And here's the genius of it, if you can even call it that. No payment was technically missed. The loan is still stamped performing, even though not a single dollar of actual cash changed hands. Sit with that for a second. A company that cannot pay its bills, and a loan that quietly records that as if everything is fine. That is the crack. And now watch what grows out of it. Jake's fund doesn't just quietly file that unpaid interest as an IOU. It counts it as income earned. The interest that was never collected in cash, that was just scribbled onto the top of a struggling company's loan, gets reported on the fund's books as money earned. And now a tax rule kicks in. To keep its special tax treatment, a fund like Jake's is legally required to pay out at least 90% of its reported income to investors. Follow the whole chain. The borrower couldn't pay. The unpaid interest got counted as income anyway. And because the fund is forced to distribute that income, it mails Jake a cash dividend built in part on interest that nobody ever actually paid. It lands in his account as real money. He spends it like real money. But a slice of it was conjured out of an accounting line and pushed out the door, because a tax rule said it had to be. And this is not a rare edge case. Across these funds, on average, close to 9% of the income they report is this kind of interest rather than real cash collected. At one well-known lender, the paid-in-kind income reported in a single recent year came to $55.9 million. The actual cash collected on those same loans? $4.9 million. Out of every dollar of interest it told investors it had earned, fewer than 9 cents actually showed up as cash. One of these investors is being paid with money that was actually earned. The other is being paid with interest nobody ever collected. Now you know which one is which. Now you're probably thinking, if a chunk of this income isn't real, why doesn't Jake's account just drop immediately? Why doesn't the market catch it and punish it instantly? And the answer to that question is the quietest, most important part of this entire video. Because it explains why Jake's statement stays beautiful while the ground shifts underneath him. When you own shares of a normal public company, its price is being argued over every single second by millions of people. Good news comes out, price moves. Bad news, price moves. The value is discovered constantly, out loud, in the open. But the loans sitting inside Jake's fund don't work anything like that. They don't trade. There's no crowd of buyers and sellers haggling every second. Most of them just sit there in the dark, and their value isn't discovered at all. It's estimated by the same fund that owns them, on its own schedule, often only once every 3 months. So the comforting marks Jake sees on his statement aren't a market telling him what his money is honestly worth. They're an estimate produced by the very people with every reason in the world to keep it looking healthy. And even with all that benefit of the doubt baked in the cracks, are pushing through anyway. One major analysis recently found that more than 10% of these private loans had already been quietly marked down by at least 50 cents on the dollar. Half their value gone. On loans that on the surface were still reported as performing just fine. By the time the damage finally reaches Jake's statement, it has usually been quietly building for a very long time. And there's one more trap Jake hasn't discovered yet. What happens when he simply tries to get his money back? Funds like Jake's often don't let you just walk out the door whenever you want. You usually have to wait for a specific window. And even then, the fund will typically only allow investors to take out a small slice in any given quarter. A common limit is around 5%. When everything is calm and nobody is leaving, that limit is completely invisible. You could own this for years and never know it was there. But the second too many people try to leave at the same time, the fund hits its cap. The exit effectively locks, and everyone still inside is simply stuck standing in line, while the value of what they're holding keeps quietly sliding beneath them. The Safe Study Income Fund turns out to have a fire exit that only opens a crack. Now let me show you what all of this actually costs in real dollars. Because I could tell you all day that high-yield funds have hidden risks, but numbers are more convincing than opinions. Same $50,000. Same 3 years. The gap between Jake and Marcus is about to make you very uncomfortable. Here we go. Same $50,000. Jake in his 11% high-yield fund. Marcus in his boring index fund. And to be completely fair to Jake, we are counting every single dividend he received and assuming he reinvested all of it. The full real total return dividends, and all over the same 3 years for both men. If the high-yield story is true, this is where it should win. Here's where Jake's $50,000 actually landed. While he was happily collecting those monthly dividends, something else was happening underneath him. The value of his fund was sliding as the market slowly pieced together that some of that reported income was never real. When you net the dividends he collected against the value he quietly lost, his $50,000 grew to about $57,800. A gain of roughly 16% over 3 years. Not nothing. Hold on to that number. Now Marcus. Same $50,000. The boring index fund. No special yield. No clever structure. The lazy choice everyone quietly looks down on at dinner parties. Over that exact same 3 years with dividends, reinvested, his $50,000 grew to about $78,300. A gain of roughly 57%. Read those two numbers next to each other one more time. Jake, who chased 11%, ended up with $57,800. Marcus, who settled for boring, ended up with $78,300. Same starting money. Same 3 years. Marcus walks away with over $20,000 more. The man who chased the highest yield in the room finished tens of thousands of dollars behind the man who refused to chase anything at all. And he did it while taking on every single hidden risk we just spent this entire video uncovering. So how did the safer-sounding, higher-paying, professionally managed choice lose to the lazy one by that much? It's the same answer that keeps coming up on this channel, because it simply never stops being true. There's a difference between a yield and a gift. Jake didn't make a stupid decision. He made the decision almost everyone makes. He looked at two numbers, 11% and 4%. And assumed the bigger one was just more money. But a yield that high is never a reward sitting there waiting to be claimed. It's a question. It's the market saying out loud something about this is risky enough that it has to pay you 11% to get you to take it on. The yield wasn't the prize. The yield was the warning label written in the only language money speaks. And Marcus didn't win because index funds are magic. He won because his money had nothing to hide. No unpaid loans dressed up as income. No dividends conjured out of accounting lines. No door quietly rigged to lock when he most needed it open. What his fund earned it actually earned. What it paid it actually had. Boring in the end just meant honest. So the next time something offers you double what everyone else is earning, with a reassuring name attached, and a quiet promise that the safety is exactly the same, don't ask whether you trust the name. Ask the only question that has ever actually mattered. What would have to be true for this to keep working? And then go find out with real numbers whether it actually is. Because that one question is the difference between Jake's 3 years and Marcus's. The yield was never the reward. The yield was always the question. Quick recap. Jake chased 11%. Marcus took the boring index fund. Same 50,000. Same 3 years. Marcus ended up with over 20,000 more. Inside Jake's fund, unpaid loans were counted as income. Real dividends were paid out on money nobody ever collected. The exit door only opens 5% at a time, and the losses were hidden inside estimates the fund made about itself. A yield that high is never a reward. It is always a warning label written in the only language money speaks. The boring investor won. Again, write that down. Now I want to hear from you in the comments. Have you ever been tempted by a fund paying double digits? And did you know about the paid-in-kind trap before this video? Drop your honest answer below. I read every single one. And if this video saved you from a mistake, hit that subscribe button so you never miss another breakdown like this. Check out the video on screen for more ways to protect your money. See you in the next one.